the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. The asset management industry has expanded rapidly, both in size and complexity, with new investment products launching faster than investors can keep up. The real challenge today isn't simply discovering new funds, but identifying which ones truly deserve your attention. When evaluating any new fund, whether it focuses on equities, bonds, or multi-asset strategies, there are key questions to consider. What is the fund's investment approach? Is the fund built on sound investment rationale? Who is behind the fund? Does that fund align with your personal financial goals? And importantly, is the cost justified, or are you paying a premium without clear benefits? Well, to find out more, joining me now is Hunter Beaudoin, who is the analyst of manager research at Morningstar. Hunter, welcome to the show.
Hi, Hongbin. Thanks for having me on.
Thank you so much for joining us. Well, Hunter, let's start with the basics. What are some of the most common mistakes or misconceptions investors make when choosing a new fund?
Yeah, so one common mistake that investors make is to be overly influenced by the marketing for new funds. So here in Hong Kong, which is where I'm based, I've seen ads in the MTR stations for these new single stock, leveraged and inverse ETFs. And each one has its own mascot, a robot transformer style. And they look really cool, to be honest, almost like they're advertising a new video game or toy. But in reality, especially in the case of single stock leveraged ETFs, these products carry substantial risk and are probably not appropriate for the average investor. So I'm sure in Singapore, you may have seen similar types of ads in the MRT stations or local newspapers, for example. And I've certainly read about a few launches there being advertised as powered by AI, which is enticing. But being overly influenced by marketing goes hand in hand with another mistake, which is simply not doing enough homework before purchasing a new fund. So whether it's due to feeling like there's limited resources or that the information is too technical, whatever it may be, these mistakes can lead to investing in products that aren't suitable for your portfolio and ultimately realizing capital losses. But the truth is, you don't need to be a financial expert or have special access to asset managers to make smart decisions about whether to invest in new funds. And that was the premise of the recent report that we just published, wherein the goal was to provide everyday investors with some tips that allow them to make more informed decisions using publicly available information. And as you went over, the report discusses considerations, including how to tell if the product is differentiated, whether it's grounded in a solid investment rationale or trend chasing, and perhaps most importantly, the fees.
Right, definitely. I mean, I've seen a couple of those ads on MRTs as well. So in a market saturated with options here, what should investors then look for to determine if a fund truly offers something new or differentiated?
So it's important to understand the fund's investment objective. So in Singapore, for example, every fund comes with something called a product highlight sheet. And this is regulated by the MAS, which is the Monetary Authority of Singapore, and it highlights details regarding the suitability, features, risks, and fees associated with the fund. So they're published upon the launch of the fund along with a fact sheet, which can vary in the level of detail depending on the asset manager. So referring to these documents gives you a sense of the basics. For example, is the fund actively managed and trying to outperform a benchmark, or is it passively managed and simply tracking the index? So our research shows that active managers tend to fare better in asset classes like China or India equities, which have historically been less efficient markets, whereas passive options are better in asset classes like US large cap growth, where active fund success rates have been near zero over the long term. But let's say you want an active fund, then another consideration is whether the investment style is differentiated from existing offerings. For instance, you may have seen in the news or even discussed on this show the Equity Market Development Program from the MAS, which is essentially a commitment to grant asset managers around 1 billion Sing to develop the domestic equities market. So they recently announced the first round of managers selected, and there have been announcements of new active Singapore equity funds being launched. So my question would be, why should I take on the risk of investing in the new funds versus the existing active funds already investing in this asset class? And that brings me to my second point, which is you also have to look at the fund's expected investment style. So is the approach investing in an asset class differently than others, whether it's potentially being the only pure growth strategy in the asset class or following a quantitative investment process. The prospectus should mention some details about the management process, and the asset manager in most cases will provide portfolio characteristics in the fact sheet. Or if you want to wait until the portfolio data is uploaded to our database, you can also use tools from Morningstar.com or Morningstar Direct to compare the portfolio to peers. And finally, it's important to consider the investment universe. So in some cases, the new fund may be the only product investing in the asset class. However, with the proliferation of the asset management industry over the past couple of decades and the plethora of new fund launches across most major asset classes, this is uncommon, unless, that is, the universe is a niche segment of the market, which can present its own problems that we can get into later.
Okay, well then how can investors tell if a fund is built on solid long-term investment rationale or if it's just chasing the latest trend?
So this is inherently somewhat subjective and tends to become clearer in hindsight, I would say. But a good rule of thumb is that if whatever the fund is investing in has been a hot topic in the news recently and or seen strong performance, it might be trend chasing. So that doesn't mean that the investment or asset class doesn't have a long-term investment case, but investing in that fund when at a time when hot money is pouring in does pose a much greater performance and hence longevity risk, because hot money will exit quickly after the hype has peaked and performance turns. An old example that's commonly cited is the dot-com bubble. Obviously, the internet certainly didn't vanish after the bubble popped, but many of the companies with unproven business models marketing themselves as internet-related certainly did.
Right. Well, I mean, thematic investing was all the rage a few years ago. How has that landscape shifted, and what should investors, keep in mind when approaching these strategies?
Yeah, we cover a lot of research on thematic investing. So our research has shown that since 2021, which was a record-breaking year for these types of funds, global thematic fund launches have steadily declined and closures have been on the rise. And we also saw the same trend when looking at the data for Hong Kong and Singapore fund markets in my report. But despite this, there remains substantial interest in these products. So investors should keep in mind that not all, but many thematic funds invest in very niche segments of the market that are the flavor of the month, so to speak. So for instance, look at the Singapore funds market. There was a fund liquidated just a month ago with an objective investing in China A-share stocks benefiting from the consumption upgrade theme. So this may not seem especially gimmicky, especially for those who believe that there's a long-term consumption thesis in China. But if you consider the context, the fund was launched in the second half of 2020 near peak performance of consumer names in the country. And the sector has since faced significant headwinds related to the sluggish economy, weakening consumer sentiment, real estate downturn, et cetera. And this fund's performance took a massive blow. In fact, it ranked dead last in its Morningstar category in the 3 years preceding its liquidation. And that brings me to another point that investors should keep in mind about thematic funds, is that our research has also shown that most thematic funds globally have failed to meet a global equity benchmark and closed down over the past 15 years. And compounding this risk, we've also found that investors generally struggle with timing their investments, especially when it comes to more volatile or narrowly focused strategies. And this results in poorer investment outcomes than the funds themselves generate. And this is amplified in thematic products because a lot of them lack broad diversification or long-term viability.
Okay. Then what should investors be looking for when evaluating the experience and track record of a fund manager launching a new product? Is it enough for a fund house to, highlight a manager's past performance, or should investors dig deeper into their relevance to the new fund's mandate?
Yeah, so most asset managers would provide portfolio manager biographies and details on what other funds they currently manage on their websites. So that's a great starting point. Most portfolio managers are also on LinkedIn, so a little social media sleuthing could also be in order. And when reading through their biography or looking through their past roles, make sure to pay close attention to the relevance of the past experience as it relates to the new fund being launched. For example, if the fund is a regional Asian equity strategy, have they managed Asian equities before? Or were they an Asian equities analyst in the past? What countries or sectors were they covering? A lot of portfolio managers might start out investing in single country markets or smaller markets like ASEAN equities, for instance, before transitioning to broader markets. However, you have to be careful here because ASEAN equities, for example, are actually a small part of the Asian equities universe. If they were a China equities manager, on the other hand, it would be more relevant. And it's also worth looking up any relevant funds that the manager runs. Check out their fact sheets. Has the performance fared well over their tenure? Whether it's outperforming or underperforming a benchmark in the case of active managers, or how has the tracking performance been for passive managers?
But Hunter, are asset managers transparent enough about who is actually making the decisions behind a fund?
That's a great point. So at Morningstar, we're constantly advocating for greater transparency for asset managers. So if you ask us, there will always be room for more transparency, no matter the fund house. Now, with that said, some are more transparent than others, but at the very least, most asset managers would provide the named portfolio managers of the new fund in the fact sheet. So on my team, which is the manager research team, we try to shed more light on the investment decision-making structure within funds under our coverage. But for new funds, I think the safest assumption is that the named portfolio managers are all involved in the decision-making process in some capacity, unless there are public communications that would say otherwise. And if you go into Morningstar.com, you can also search up the portfolio manager, and we have a list of the other current funds that they manage, as well as their start and end dates. And this kind of facilitates an even more detailed, performance assessment.
But how can investors then decipher whether a new fund will be appropriate for their objectives and risk tolerance?
Yeah, this is tougher, because it varies on an individual by individual basis. But I would point again to the fund filings. So check out that product highlight sheet that I mentioned. Check out the prospectus, the fact sheet, all of which should be available at the time of the launch. So pay close attention to the risks that are listed on these documents and see if you're comfortable with them. Also, you can look for portfolio statistics like the percentage of assets in the top 10 holdings, the total number of holdings, and to get a feel how concentrated the portfolio will be. And there will be limits on sector or geographical exposures that might be stipulated in the document. So it's important to understand where the fund will have exposure within the universe. For example, if you're buying a core global bond fund, you can check the fund's leeway to invest in high yield securities. Mm-hmm. It may actually be more than you're comfortable with, and it could result in performance patterns that differ from what you would expect from a core global bond fund. So this would be something to look out for in the documents.
Fund fees, they remain one of the, strongest predictors of long-term success, yet they're often overlooked. Why is that? How should investors approach performance fees?
That's right. Yeah, fees are one of, if not the most reliable indicator of a fund's future success. So our research has repeatedly shown that lower cost funds tend to survive longer and outperform their pricier peers. Fees may be overlooked because they aren't highlighted by the asset managers, or they may seem small given they're cited as just a percentage, or they can even seem complex with the different structures, or any combination of these reasons. But a minority of funds also even charge performance fees, which have their own set of considerations associated with them, chief among them being that they tend to not be structured not be structured symmetrically, meaning that these funds charge performance fees when there's positive performance, but investors are not compensated for lost performance. So I think if you take anything away from this conversation, it's definitely to check the fund fees and try to compare them to existing funds investing in the same asset class. We talked about earlier how to figure out the edge of a new fund over existing offerings. So if the fund charges substantially lower fees than any existing fund investing in the same asset class on the market, that could be a strong case for differentiation.
All right. Well, some great insights from you there. But before we let you go here, Hunter, any final advice for investors who are considering a new fund?
Yeah, to return to my first point, it's really just to stay critical. With so many products in the market, it can feel overwhelming. However, this abundance also means that you have choices, and asset managers are constantly under competitive pressure to deliver the best performance. So by following some of these tips, you may often discover that existing funds are actually better suited for your portfolio than a new fund. But if you do decide to invest in one, you can at least feel more confident in your decision, knowing that you've done some of this due diligence.
All right. Well, thank you so much, Hunter, for your time and your insights today.
Thanks, Hongbin.
Thank you. That was Hunter Beaudoin, who is the analyst of manager research at Morningstar. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.